If you've been watching silver lately, you know it's been a crazy ride. One minute it's soaring, hitting massive highs. The next, it's falling hard. But what's driving the volatility? It boils down to two things. Many of you have heard these things before: the growing demand from modern industry and decades of documented manipulation by some of the biggest players on Wall Street. Today, we're going to dig into three critical questions regarding the market. And these are things that everybody should know a little bit about. So let's start off with talking about the ugly truth. Silver prices have long been a history of suppression. The system allows this primarily because the price of silver is mostly set through the paper market. Now, this happens through things like futures contracts and the derivatives, not the physical metal itself. The main crime here that I'm going to talk about today is something called spoofing. It's illegal and it works something like this. A big bank drops a huge order to buy. They make the announcement at least. Everyone thinking this price is about to skyrocket, everybody jumps in. The small traders follow suit. But the bank doesn't actually intend to complete the big order. Matter of fact, they cancel it almost immediately. They were just, quote unquote, tricking the market so that they could execute a smaller market, a more profitable trade on the other side. Now, this creates a false sense of supply and demand. I'm going to take you back through a little bit of history regarding some of the most famous spoofing and JP Morgan Chase. Now, JP Morgan was found guilty of running this scheme across the precious metal market for over 8 years, May 2008 till about August of 2016, and tens of thousands of fake trades. The consequences, massive. In 2020, JPM had to pay a record $920 million. This massive fine included money to pay back the people that they had cheated. This is called restitution. They also had to pay a penalty for their ill-gotten gains. This is disgorgement. Now, this confirms that financial industries have a proven history of pushing silver prices down for profit. Again, we're talking about three of the major fines: 920 million, 436 million, 311 million. These are some penalties paid because of this, and it's not just located at JP Morgan. So what do we do about this? Let's talk about a fundamental question that honestly doesn't really make sense to me. And that is, silver is currently mined from the earth at a ratio of about 9 ounces for every 1 ounce of gold. Yet today, it takes about 80 to 85 ounces of silver to buy a single ounce of gold. Why the massive difference? Historically, governments knew that silver was more common, but still valuable. The Roman Empire fixed the ratio about 12 to 1. The U.S. Coinage Act of 1792 fixed it at about 15 to 1. But the reason the price is about 80 to 1 right now, primarily manipulation and industrial demand. Again, over half of all silver mined is immediately utilized for things like solar panels, 5G electronics, and electric cars. Gold, primarily investment. They also use it for jewelry, and there are some things connectivity wise, but it's more of an investment based metal. The big one is the power of the paper. Because the silver market is so much smaller and less liquid than gold, it's easier for powerful institutions to take those paper contracts to keep those prices artificially low. And we've seen this suppression. This is where it's easier to maintain that high 80 to 1 ratio, even though the physical reality should be more like 60 to 1, or maybe even 50 to 1. But here's something that you all have probably heard: the big channels, the big dealers, the miners, big volume versus scarcity claim. In normal markets, if people buy something, the price goes up. And despite retail investors buying massive amounts of physical silver, 1.5 billion ounces between 2010 and 2014. The big distributors, what do they often claim? They claim that supply is inadequate. Well, why is that? Let's look at the difference between the conflict between the paper market and physical markets. You've heard people talk a lot about this, but I need you to think a little bit more critical. Don't listen to what they're saying on the surface. Actually dig into it a little bit more. Look at the fundamentals. The big claim the major exchanges often point to their large stockpiles. COMEX reporting an extraordinary 526.1 million ounces of inventory. And they're like, there's not really any scarcity. However, when you look at some of the fundamentals that other people have put out, you can see that we've been in a sustained deficit for years, most likely from industry at the tune of about 184 million ounces. We have to look at why that's the case. Some institutions claim the supply is fine, while other dealers report that they have to increase their premiums because they're no longer getting the delivery of their bars and their coins. London, the world's biggest physical trading center, borrowed cost skyrocketed at 11%. It was a clear signal of extreme physical tightness. Now, we've talked about this. This goes back to the buying of contracts. When contracts come to call and they have to get that silver, maybe they have it on hand, maybe they don't. So what do you want it to do? Before we go to that question, I want to talk about this silver shortage and who it generally benefits. Have you ever thought about that? You hear these people talk about this silver shortage. They're going on like a broken record, but who does it benefit? It benefits the producers, the investors, and the sellers of physical silver. Now, when I'm talking about investors, I'm talking about the large holders of physical silver. First off, we talk about the miners and the producers, the high revenue and profit margin, how less supply causes surging prices. We're seeing that now. See, the companies that mine the silver see increases in the price that they get for their product. Since many of their prices, the mining and labor, are fixed term, we're going to break some of this fixed versus variable here in just a moment. What it does is it leads to significant increases in operational profit. This is a phenomenon known as operational leverage. All right, let's talk about operational leverage. If we're looking at it from a silver miner's perspective, then we're looking at a way to measure how much of the company's operating income is changing in response to the sales or the revenue. Now, it's determined by the ratio of fixed cost versus variable costs. So you have high operational leverage, meaning that the company has high proportion of fixed costs. These are costs that don't change with production volume, rent, salaries, the initial investment in the mine. And then you have low variable costs, and these costs are associated with the production itself, the raw materials, or perhaps shipping. Now, what's the benefit? When the revenue increases, the price of silver goes up. The fixed cost remains the same, but once sales exceed that breaking point, all that extra revenue drops straight to the bottom line. Now, this causes profits to increase faster than the revenue and creates what they call an outsized benefit. Now, this happens during the commodity price rally that we've seen so far here in October. What's the risk about that, though? If the revenue fails, the high fixed cost leads to significant losses, and the company has to cover those large, unchanging expenses. And there's a formula here. The degree of operational leverage, or the DOL, is equal to the percent change in operating income over the percent change in sales. Now, I'm not asking you to become math experts, but if you want to know more about that, let me know. So let's talk about some examples of how operational leverage is utilized. So we use the silver miner example, the fixed cost, the cost to purchase the mining equipment, the salaries, the engineers, the management, the initial construction, all of that kind of stuff. That's all fixed cost. But the variable costs are things that change periodically. These are electricity, the explosives utilized to mine, fuel, maybe some labor cost tied directly to the processing of the ore. Now, the scenario that I want to give you is, let's say and this is just simple math, folks, okay? $20. $20 is the price for a mine to produce an ounce of silver. But if the price rises from $30 an ounce to $35 an ounce, that's a 16.5% increase in revenue. Now the profit jumps from $10 to $15, which is a 50% increase in profit. Now the operational leverage here is high because the $5 increase entirely bypasses all of that fixed operating cost. This is free and clear. I want you to listen to that very carefully because we're going to talk about why this plays such an important role within your silver bullion and your coin shops. Okay, so let's take some other sector. Let's look at the retail sector, the grocery store. The local grocery store has low operational leverage. They have the fixed cost, which is the building, right? They have to manage the salaries, but their variable costs are greater. Their variable costs are the food, the goods, the inventory, the wages, the cashiers, the energy to run freezers and things of that nature. If the grocer's sale increases by 10%, their operational profit will increase by a similar or slightly lower percentage. Let's say 8%. This is because they have to buy 10% more inventory and pay more hourly wages in order to support those extra sales. Okay, potentially confusing. Let's put this into language we all understand. The coin or the bullion dealer. Low operational leverage. Why is the mine more productive? It's a lower cost, right? They don't have to buy anything. They're mining the product. And so once they get past all their fixed income, it's all profit based as long as the price continues to go up. Now, there's major risk if the price drops or plummets. So let's talk about the coin shop or the bullion dealer. Now, a bullion dealer who buys silver bars and coins from a wholesaler or a refiner sells them to the public at a lower operational leverage than the miner would. This is because they have a high proportion of their costs tied to that variable cost structure, which is the inventory itself. This is why you'll hear people say that coin shops and bullion dealers are not designed to buy your silver. They're designed to sell you silver. Imagine that a dealer purchases a 1 ounce silver coin for 33 bucks. Okay. In order for them to make a profit, let's say $2, they have to sell it to you for 35. So the sales increases. Okay. The increase in profit is closely tied to the increase in sales revenue. See, in contrast with the miner, the profit margin on each ounce widens dramatically as the price rises with their production cost. Because again, their production cost is fixed. A bullion dealer's profit is typically small, a fixed dollar amount or a percentage over spot price, but the margin is more stable and less sensitive to fluctuations than the miner's profit, meaning they don't make as much and there's less risk. Whereas the miner has a little bit more variability in their profits. The key difference here is that a dealer consistently has to replenish their inventory. This is why a dealer is not necessarily set up to buy from you. That's why in these times where it's high, yes, they can purchase, but they're trying not to buy from you because they got to find the lowest possible rate to offset that. Remember, the cost of the goods also goes up proportionally. The majority of the dealer's expenses rises based off of preventing that large exponential profit loss or that boost against the operational leverage that may be provided by it. I hope that makes sense. Remember, stability means that the dealer is less exposed to volatility. These are swings in the commodity market. But unlike the miner has a high operational leverage, meaning that their experiences massive profit increases or devastating losses when that commodity price changes. But for the next few months, experts believe that silver is likely to find strong support and stabilize. It's a very bullish market. But some analysts suggest that if the correction continues and it punches through that floor at 47, if it doesn't hit any resistance, the support level that's next is 40 bucks. And this could hit and then bounce, beginning the next major upward move. Ultimately, silver market is battling two realities: powerful manipulation, the driving the price down, and the clear, undeniable physical scarcity that has been stated by the industrial demand. Now, knowing the difference to these is the key to becoming a smart investor. But remember who you listen to. It's important to ask these questions and do your own research. Ladies and gentlemen, I want to be clear. The information that I'm presenting here, including any forecast or discussion education, it's only for analysis purpose only. This isn't financial advice. I don't want you to take this recommendation and go buy or sell any of your assets. Do your own research and make up your own mind. But do me a favor, if you want to stay ahead and be informed and combat misinformation, either with silver, gold, or with the numismatic collectibles, subscribe to the channel, hit the notification bell, and I will see you in the streams. Take care.